What's going on, guys? It's Tickers and Tokens here, back with another video. Today's video, guys, I want to talk to you about Meet Kevin. He has made a really bold prediction about the housing market, and we're going to react to this video together. Let's watch it.
Reamed. We were expecting a month-over-month decline of 4% for pending home sales. We actually got a negative 10% decline in September, way worse than expected. Sales are now down 31% year over year, and this is where
Oh man, home sales are down 31%. Oh man, that's rough. You've seen the housing market starting to finally collapse, y'all. Oh no. So we've seen interest rates starting to finally get higher and higher. And, along with that comes the mortgage rates and the loans you got to pay out. And you think about your rents and stuff too. Like, a cost of owning a home is going up. So landlords and stuff are going to have to charge more and more rent. So you got buyers just capitulating in the market, man. They're like, nah, we tap out, man. We're done. We're done with this.
a lot of folks who talk about the housing market say, hey, but inventory is still in short supply. Yes, maybe. Inventory might be at much lower levels than what we've previously seen, but if you start actually selling less of these homes, the metric of months supply of homes extends. That's because if, let's say in a normal market, you have 200 homes on the market, but now you have 100 homes on the market, you have half the supply. But if usually 10 sell a month, that would be 10 months of supply. But if now only 5 are selling a month, you have 20 months of supply.
Right. So it affects the entire supply of the market, guys. So and again, what he's saying is that it's downstream. So going 3-6 months out, you're going to see a huge supply of houses in the market. Which if you know anything about basic economics, it's just supply and demand. If there's more supply with less demand, it's going to bring prices down across the board. Now, the size of the housing collapse, that's a whole other issue we can get into. Maybe he will, but I can see housing maybe coming down another 10-15%. Just prices of homes. As long as we keep interest rates up, mortgages ain't going nowhere. But the home prices, I think they can drop another 10-15%.
So the fact that less homes are selling is a concern for how much home prices could continue to fall. And in this video, I want to touch on some of the reasons we could actually see that sort of supply increase and we could continue to see pain in the mortgage rate market. Now, first things first, generally, we pay attention to the 10-year Treasury yield for what inflation is doing. And I think we're going to still have a very hawkish Federal Reserve here in the November 2nd meeting, which is likely to drive and keep those 10-year Treasury yields.
Market's still pricing in 75 basis points, y'all. So keep that in mind. This will be the fourth 75 basis point rate hike, man. It will actually be a first. It's historic if they do it at 75. The first time they've done 4 75 basis point rate hikes consecutively. Very first time. Man, it's been a historical generation to be in, huh? Past couple of years has just been history changing, to be honest.
Yields right around 4%, which is roughly where we sit now. I don't really expect these Treasury yields to peak until 2 to 3 months before we actually see the Federal Reserve get to peak.
I noticed they are coming down, though. I guess that means the short-term ones are probably going up in value. They keep fluctuating a lot, so it's hard to really say what kind of trend we're on, really. But last time I looked at them, they were like 4, a little over 4, 4.2, 4.3. That was for the 10 and 30 year. Now we're seeing, you see it right here on his screen, he's got it at 3.99, just under 4. Man. So as long as the yield curve is inverted, that's supposed to be a leading indicator for a massive recession. So even the recession we're in, the not so quite recession that nobody wants to say we're in, but we actually are in. Yeah, apparently that's being put on pause because we actually had our GDP numbers come in today, and they were up. Our GDP was up 2.5%, somewhere in that range. So the recession's on pause for right now, guys. I paused the game, so we ain't got to deal with the recession for a little while. But oh man.
Rate hiking cycle, or a rate hiking cycle, which if we expect the Fed to peak out on rate hiking around March of 2023, we'll probably going to see the 10-year peak closer to January of 2023. Now, with a 10-year sitting at 3.99, we're really seeing mortgage rates above 7%. You could easily see this just by typing into Google mortgage rates. I generally recommend you change this interest rate to
7% is just ridiculous, guys. I mean, come on. Who can afford a house with that? I mean, let's be real. Who's out here paying a 7% mortgage, man? I mean, never mind rent. I mean, if you're renting, like, they're going to pass that cost on down to you. If you're like a landlord who's like actually mortgaging the house and everything, oh man, rough. You know, some of these landlords will mortgage houses to buy more other properties and mortgage that to buy other properties, and it's a whole cluster, man. It's just people just trying to screw each other over. But I guess that's always been the real estate market if you really think about it. So.
To 740, that's generally your prime mortgage rate. And you can see that mortgage rates for the 30-year fixed are sitting at about 7.2%. That's a solid 4.5% greater than where we sat in December of last year, which reduces about 45% of buyer purchasing power. But there's a problem with mortgages, and that's the potential that the Federal Reserve...
Of course, we get an ad.
Reserve starts selling off mortgage-backed securities. See, unlike treasuries where they just roll them off, mortgage-backed securities might actually begin to be sold by the Federal Reserve. And this is going to create a very, very real risk for real estate. The 10-year treasury yield could begin to fall early next year, but mortgage rates could potentially stay high if the Federal Reserve starts selling mortgage bonds, which means that we will see prices for bonds on mortgages come down and mortgage bonds actually increase. That means you see what's known as a wider spread between risk-free treasuries and mortgage rates. And when credit spreads rise, you could actually be in a situation where the 10-year trends down while mortgage rates continue to trend up.
Yeah.
And the Fed, while they've...
Which is what we're starting to see, and I think we'll continue to see, man, is people are going to spend more money buying. I'll put it like this, man. You've seen the way the growth stocks have just been going flat and just getting absolutely leveled this year. The market's putting a huge premium on safety stocks right now. It's safety bonds, safety, just all safety plays, man. The market's just all in on safety right now. They don't want anything to do with any kind of risk. We are completely risk off. So why would you buy a stock or a house, for example, when you got to pay this much premium for the stock to get you this much money, or pay this much to get the house, and then do all this cost and stuff to fix it up, when you could just park your money in a bond and make it guaranteed 4, 5, 6, 7% return. Inflation bonds 8, 9%. I mean, market's just thinking that overall the picture of equities and the picture of real estate just ain't worth it, man. And if you're smart money, I understand that. I can definitely see why you would feel that way.
They've been talking about selling mortgages, mortgage-backed securities. They have not actually undertaken, excuse me, they have not actually
dying. Somebody get this man some water.
Undertaken. I'm still getting over this cold. It was ridiculous. They've actually not undertaken selling MBSs yet, mortgage-backed securities. When that occurs, there could be some real fears that mortgage rates continue to maintain higher levels, and we see more pressure on the real estate market. Take a look here. This shows us that with caps on redemptions on treasuries and agency mortgage-backed securities doubling in September, the pace of the balance sheet runoff was set to increase in the coming months. The markets for treasury securities and agency mortgage-backed securities continue to function, although liquidity conditions in both markets remain low. Low liquidity conditions is not good. That means you have less buyers for treasuries and mortgage-backed securities. Less buyers means higher rates. And listen to this. We're starting to get this talk. A couple of participants remarked that after the process of balance sheet reduction was well underway, it would be appropriate for the committee to consider the sale of mortgage-backed securities in order to enable...
Man. So they're looking to just completely clear off their balance sheet, man. That's basically what they've been saying all year, but they're finally actually following through on that. They're clearing off their mortgage-backed securities. It's about damn time, honestly. But yeah, we already know they're hiking the interest rates, yada yada. But that's the part nobody really ever talks about is that balance sheet, man. They got so many assets of they've been buying throughout the entire last 2 years that they had like 9 trillion bonds and treasuries and stuff on their balance sheet, mortgage-backed securities, stuff like that. They're starting to sell it off by like a couple hundred billion. It's supposed to be like every couple months, every month or so, and they're doing it slowly, man. Just like the interest rate hikes, just doing it slow and slow. They just want you to feel every bit of pain that you can, man. It's just
to enable
rough.
suitable progress to their longer term goals. Notice, folks, this was the report of the minutes that came out just a few weeks ago from the Fed
Skip ahead just
bonds,
a little bit.
collateralized loan obligations, as well as pulling money from almost any fund that'll give it back. The more pension funds pull back, the more real estate funds have to start dumping real estate. This is a Bloomberg article here from just 9 days ago here. This is recent information, and it's recent information that unfortunately is likely to get worse. And it's not just commercial real estate, it's also residential real estate. And that's just the nature of pension funds having to balance the fact that they have a lot of debt. Unfortunately, a lot of this occurs with a lag in the real estate market, and that unfortunately leads to
Time out. He flipped on me. Flip flopper. That's flip flopper Kevin for you.
pain likely not really being fully realized in the real estate market until we start lapping the highs of real estate prices that occurred between March and May of 2022.
All right, yeah, we get the point though. Yeah, so just real estate market, just in general, y'all, is just really having a hard time, and I think the worst of it's yet to come as far as housing goes. I think with inflation coming down the way it is, I think we should see some improvement maybe in home prices. By that I mean if you're looking to actually buy a house, I think if you wait just a couple more months, I think you'll see that prices on houses are going to come down pretty significantly. And if you're a millennial or Gen Z, you already know the houses have just been unaffordable for your entire working adult life. It's been horrible, man, trying to get a house. I'm glad I got one. So if you, I hate it for people who have to struggle just to keep freaking roofs over their heads, man, and have to just try and you can't even invest in real estate, man. You can't. What happened to the American dream where you could just own a home? You know what I mean? Like, why has it got to be so difficult just to have a damn house? You know, it's just a house, just a little bit of wood and a little bit of glass, man. That's all you need. And that's all they will don't want to let you have. And you already know the big money, man, they're waiting. They're waiting for these prices to drop. They're going to wait and wait and wait, and they're going to buy them up on dirt cheap. You already know the whole World Economic Forum, and they're saying like, oh, you'll own nothing, you'll be happy by 2030. They're going to try to just buy up all the houses, y'all. Just be prepared for that, and maybe invest in some not financial advice, maybe invest in some REITs, some real estate investment trust, man, and you can get you some. That's closest thing you can get to real estate, man. Just do that, and you can because real estate's a good asset class to be in, y'all. It's one of the fastest ways to grow your wealth if you have the capital to do it. No, I don't think anybody should go massively into debt unless they really know what they're doing, especially not getting real estate with massive amounts of debt. And you also want to have money to back yourself up in a situation like that. So I would just stick to REITs, as I call them, real estate investment trust, man. It's a fund, like an ETF. It's a basket of just real estate properties. The first one that comes to mind for me is Realty Income. We can go ahead and move that right quick. Let me move my head out the way. Pull my screen up. I'll show you guys Realty Income. That's a way you can invest in just real estate without actually owning any real estate. Realty Income stock. Yeah, this is it. Yeah, it's a REIT company, Real Estate Investment Trust. So yeah, they're a real estate investment trust that invest in freestanding single-tenant commercial properties, United States, Spain, UK, subject to NNN leases. Yeah, and they own I think it's like 11,000 properties or something all across the U.S. and all across a good portion of Europe. And they pay like something close to a 5% dividend. I don't personally own this stock. It's one I've been watching for a while. I feel like it trades a little rich right now, in my opinion, but I think it's going to be a good value at some point. It's trading for a PE of like 60 something right now, which is really high for a stock like this. But just keep in mind, I think the prices will come down, especially with home prices being as inflated as they are, and I think they're likely to crash. Maybe not crash, but at least come down in the next coming 6 months or so, at least like 10, 15%. So even if you can't get you a home, you can look to just get you a good REIT, a real estate ETF. But yeah, guys, that's going to be the end for this video today. I just want to bring some information to y'all, give my own thoughts on what me, Kevin, had to say about the housing market. If you like this video, please like and subscribe, and I'll see you guys in the next one. Take care.